All right, how we doing, everybody? Long time no see. We got a stock market update for everyone here. A lot has gone down. We've had a Fed meeting. We've had a lot of earnings. Market's been more red, more on the sick side than on the rip side, but that's fine. We're ready for that. So we'll take a look here at the S&P 500. Where are we at here? Just a little bit of a dip, nothing crazy. Again, last year, big run up, or run up at the beginning of this year, and we're seeing a little bit of a pullback. So, not the end of the world. Um, a lot of earnings coming out right now, and the market really made a big move before these last round of earnings. And you saw if they gave bad guidance or they missed, they got hammered. And if you had met expectations and laid out good guidance, the stock didn't really react either way, to the downside or to the upside. And a lot of that is because, good news was already priced in, right? So the market has already moved so much this year that unless you came out with NVIDIA numbers, which is interesting, they killed their earnings. They are just people are giving up their firstborn babies to get some of those chips, which is great for them. They're a great company, and they're doing really well. Um, but their stock ripped after hours, and then the next day it gave it all back. So people taking some profits there. But anyways, just the market was kind of expecting good earnings, and if you missed expectations, you got hammered because most stocks have moved up so much in these last 6 months or so. So the big deal here is going to be rates. So 1 year interest rates are staying nice and steady. When we look at the 10 year, we were at this level October of 22, and we've kind of retraced that, and then we've shot right back up to that. So it'll be interesting to see how the 10 year does. But if you got cash and you don't own bonds and you're looking to buy bonds, great time to do it. In my opinion, not a financial advisor. Do your own research, do your own homework. But you have not been able to buy a 10-year bond and get this yield for, you could have done it last year, but it's been a long time since the government's been giving out this kind of cash if you want to lock your money up into bonds. So let's go take a look at the bull bear base case for us. We're going to talk mainly about the bear case because those are the issues that we need to resolve in the short term. The bear case, or I'm sorry, the bull case long term, things still look intact, and not a lot has changed there since I last talked to you guys. So bear case, inflation, no new news there. I mean, oil's kind of coming up and settling out around $80. Just expect things to cost a lot of money. I don't expect things to all of a sudden plummet in price, which would not be good for companies' earnings, and that would not be good for the economy. But we are not seeing inflation increase at the rate it was in the past. That is the little pat on the back that the government and the feds want to give themselves when they say inflation is improving. It's not that it's going down, it's just not going up at the same rate. You'll hear me say this over and over and over because inflation's a psychological game. Things are still stupidly expensive. Your dollar is still worth less today than it was 5 weeks ago, 10 years ago, however time frame you want to look at it. So inflation is getting better, but it's still something we're always going to have to deal with. Interest rates, they're going up. So if you have a variable loan, that's not good for you. But if you're looking to get interest, that's a great thing. So I have interest rates green here because they're most likely done raising rates. Maybe one, maybe two, maybe three. I doubt any of those, but they're getting close to the end, if not done already, raising rates because they've gone from 0 to 5%, lickety split. They got to be getting close to be done, if not done already. Credit crunch and the banks, this is still red. The longer that rates stay high, If you think about it from a bank's perspective, rates haven't been this high in 15 years. So every loan that the bank has made in the last 15 years, they're underwater on, right? They are lending out money for a lower rate than they could today. And if people pull their money out of the banks, they have to absorb some of those losses. You've got commercial real estate. So some banks are in better shape than others, but the higher interest rates, the higher they are for longer, is putting pressure on the banks unless they can make margin off of their interest, right? So if you have your money in a savings account and they're paying you nothing and they're able to take that money and put it into some sort of bond and get 5%, there's a little yield for them to make there. But if you're taking your money out of a savings account because they're not paying you any money and go put it into a bond yourself or go put it into Charles Schwab or Robinhood or whatever, there goes money out of their control that they can lend out and also gain interest on. So that's not good for the banks, and that won't be resolved for a while. Commercial real estate still red. Again, the banks and the real estate, those are going to take a long time for them to work themselves through. But from what I'm seeing, I'm not seeing things get super, get worse exponentially, but they're also, the problems are still there and they're not getting better. I don't have a lot of insider information on either of these two, so they're still there in my eyes, and they're not getting better anytime soon, and we'll have to keep working with those for a while. Rich valuations are getting better in a lot of the tech stocks and other companies like that out there, so that's great. Yield curve inversion, we're starting to see that flatten out. So again, once we uninvert, that's when the recession tends to unfold after we uninvert. So the fact that we're getting from uninverted to flat and possibly uninverting, then we'll have to see, okay, how's the economy doing? What are we looking at here? So just keep your eyes and ears perked because we're getting closer to that point. Earnings haven't bottomed, question mark. This was on here before the last earnings cycle. The thing with earnings was the expectations, the bar was moved so low, and a lot of companies met the bar and are starting to put their guidance above that bar. So it looks like the earnings may have bottomed and we're starting to come out. But every company is different. Every sector is different. So that's where I think we are going to continue to see a rolling recession where one sector takes the hit while another sector is doing well, and then it rolls on to the next one. So last year energy was great, while a lot of other things suffered. This year you're seeing travel do really well, you're seeing technology rebound, and you're seeing energy be soft, you're seeing healthcare have some issues, you're seeing banks have some issues. So it's a rolling recession. Each sector is kind of experiencing at different stages their pain. So for here, earnings haven't bottomed. I would say for some of the big tech companies, earnings have bottomed, but maybe for some other companies, other sectors, retail doesn't look so great because they have some issues that they need to figure out post-pandemic with inventory. And then you're hearing a lot of shrinkage, meaning theft, eating into their margins. And then also the long-term story for retail doesn't look that great when you can get a lot of things on Amazon. So things like that, that's a good example where you're going to have rolling earnings recession. So some sectors, maybe earnings haven't bottomed yet. So this is going on for about 10 minutes. I want to end it real quick here. Opportunities to look out for. These are still the same. I do like healthcare. I like the XLV ETF. I do like some REITs, but you need to know what you own. Don't get caught buying a commercial real estate REIT. So know what you own when it comes to REITs. I've given some examples on the ones I like. I think bonds. I think right now, if you don't have bonds and you want to get allocated to bonds, you can get money locked up for 10 years, 5 years at a rate that you couldn't for a long, long time, 15-year high. So not a bad idea to put some money and lock it up there if you don't need those funds for 10, 15 years, however long you're going to lock it up, whatever that looks like for you. Buyable dips for tech. I have been buying a little bit of tech. I'll get into that in a second, but I'm still being very patient. I think seasonality, the market doesn't like September, October, and we're about to run into those months. After good earnings, not great, but the market has moved up so much, I could see there being a little bit more rotation out of tech into other names, and that'll give a great opportunity to reload into some tech names. Always avoid FOMO, never chase green candles. Um, so let's talk about some things I'm buying long term. The ones here that are in orange, I'm nibbling, but I'm being very patient. I'm only adding when there's really bad days. So ENPH, I love the company. Tesla, I love the company. But mainly ENPH here. The longer that interest rates stay up, the less solar people are going to buy because you have to finance that. Similar case with Tesla. But with Tesla, there's so many tax credits and incentives that to finance the car, people are overlooking some of those interest rates just because you get $7,500 tax credit, $2,000 gas card, or charging miles, whatever. There's all these incentives that they're throwing out, and the price of the cars keep dropping. That's not the case for Enphase, but long term, great company, and I think this is a great opportunity to build a position. I just don't think there's a huge rush to say I need to go buy it today. It's around 125. Wouldn't be surprised if we see it at 110. Wouldn't be surprised if we see it at 105. But in my opinion, right now at these prices is a good time to buy. But I do think there'll be better opportunities. Same thing with PayPal. I'll come up with a video on PayPal, maybe Enphase also. Definitely, I'll bring out a video on Amazon. Um, so PayPal, just no rush there. I just don't see the market just flipping 180 and saying, "Oh my God, we love PayPal all of a sudden." PayPal's a good company. They just elected a new CEO, so I think you give him a couple quarters to see how he's doing running the show, and maybe he shakes things up. So, anyways, those orange ones, I'm buying, but I'm nibbling, and I'm waiting for there to be a better price point to really load up with some size. The ones here in the green, I've been buying, and I think they're fair value right now. Um, but everything may go lower, so I'm not blowing my whole wad here. But these are the ones that I would say I'm being a little bit more aggressive on buying. The healthcare ETF XLV, VICI Properties, a REIT. I think one thing that's interesting about REITs is because rates are so high, people are selling their REITs to go into bonds, which totally makes sense. But the minute that rates come down, people are going to flood into REITs to get that dividend, that yield. So we'll see if that's the case. Amazon, I love this company. I love their earnings. Every time I listen to their call and research their numbers, this thing's a sleeping giant. I really think that this is going to be a big mover the next bull run. So I'll come out with a video on Amazon. But again, tech, being patient on tech. So I'm adding to Amazon, but I would love to buy it in the 120s, not so much in the 130s, maybe 115. We'll see if we get there. But if we don't, I've been nibbling a little bit just because I don't own enough. The more research I do on Amazon, the more I realize I don't own enough of this company. They are a sleeping giant. And then the things I'm really looking for, the SMH, so the semiconductor ETF. We need so many more chips. Great English there, Matt. We need so much more infrastructure, and we need more computing. So your average PC is underwhelming for what we're trying to ask it to do. Your cell phone is underwhelming for what we're going to ask it to do in the near future. Every device is going to need chips, and so that whole situation is only going to keep getting better. The triple Qs is just a base NASDAQ ETF. I'm looking to add more again on size. I'm nibbling here and there in retirement accounts, but I'm waiting to see 142 to really get more aggressive, maybe 150. Palantir, Shopify, SOFI. So there's some other tech companies. I like the business, been following them for a long time, but I'm waiting to get them at a better price. There's only so much powder to be thrown out there, and patience is key. I'll leave you all with this quote from Howard Marks. It's not what you buy, it's what you pay. So chew on that. I got to go hit some shoulders. I hope everyone stayed this long. If you're here this long, I appreciate you. Hit the like button, and I will talk to you all soon. Peace out.